I think that it's finally safe to say that we are in a bear market, and as much as this sucks for our long-term portfolios, you can still make income through options trading with these three strategies that I'm going to share with you that have made me $1,950 so far in this bear market. I've already covered these strategies on the channel before, but today I'm going to give you the recap of these trades that I've made to show you the real results that I've seen over the past few months and how you can implement them yourself. Whenever you think of a bear market, you probably think of buying put options. And you're not wrong under this assumption, because whenever stocks fall in value, the price of a put option should go up. Because of intrinsic value, if the option is in the money, you can sell your stock with a put option for a higher price than what the market value is for that stock. But the problem with put options right now is due to extrinsic value and what's known as put skew. So because we have such a volatile market going on right now, you're going to pay a lot more for a put option than you would for a similar call option. For example, if I bought this SPY 426 call option, I would pay $805. And this is even in the money where it has intrinsic value. But if I bought the same strike price, same expiration date, but with a put option, I would pay $880 in order to open this. This means that I'm paying 10% more for this put option than the in-the-money call option. So right now, I'm not buying puts. Instead, I like to act as a casino, a little role play here, and I like to sell these put options to the market. Now, not just any put option, okay? My criteria has actually changed for selling put options. Usually, I would set my expiration date to 30 to 45 days out. But right now, there's so much uncertainty in the market, so I'm not using this time frame anymore, at least in this bear market. What I'm using instead has been 2 to 3 week expiration dates, and because of the higher volatility that we're experiencing, I'm getting about the same amount of premium as if I were to sell those 30 to 45 day expiration dates. So whenever you're in a bear market and you're selling options, I would consider shortening your expiration date just because of the uncertainty in the market right now. And in order to put the probabilities even further in your favor, what you're going to want to do is lower your delta value. Usually, in a regular market, I would suggest a 30 delta, but with this crazy market that we're in right now, I want to stack the probabilities as far in my favor as I can. And then lower your delta value whenever you're selling options, the higher chance that you have of not getting assigned to have to buy your 100 shares if you're selling a put option. So instead of using a negative 30 delta like I would in a bull market, in a bear market right now, I'm using a negative 20 delta. This means I have a 1 in 5 chance instead of a 1 in 3 chance. So again, we're stacking the odds in our favor by having a lower delta and also having a shorter expiration date just because of the high uncertainty that's in the market right now. Now, let's get into our example. When it comes to a cash secure put, you should probably pick a stock that you actually want to own 100 shares of. So one stock that I own 100 shares of on this portfolio is Himax, and if we go to their option chain, it fell by 4% on Friday, so we're going to shorten our expiration date to just 2 weeks out instead of 3 weeks out. We're going to select sell puts in the top left, and we want to find a put option that has a negative 20 delta. So this 950 has a negative 24.27. This $9 put has a negative 16.5. So choosing between these two, I'd probably go with the one that pays a little bit more in premium. So we're going to sell this 950. We're going to get paid $28 of credit in order to open this trade, which means that if Himax is above 950, our strike price on our expiration date on April 1st, we get to keep the $25 of credit that we get in order to open this. We also get to keep the $950 of cash that we're going to put down in order to open this trade. But if Himax is below 950 on our expiration date, we're going to have to buy 100 shares that are 950 strike price. But technically, we're not paying 950 since we're getting this $28 of credit. This means that our break even for this is going to be $9.25. Now, if Himax continues to drop below our $9.25 break even price, then that's when we start to take in unrealized loss. So if Himax drops to like $5 for whatever reason, then we would be at a $450 unrealized loss until we sell those shares, and then it would become a realized loss, obviously. But so far in this bear market, the strategy is treating me pretty well. I don't use it as much as other strategies because I don't like locking up that much capital. But the first time I used this, I made $40 of profit, and then we go to Himax, we go to the history on the stock. I got another $40 of credit in order to sell a $10 put expiring on April 1st. So in total, I've made $80 by selling put options on Himax for collateral of around $1,000, which is about an 8% return so far in this bear market. The problem with selling puts, though, is that you need enough money to buy 100 shares of your stock, either with cash or margin using naked puts, and not everybody can afford to buy 100 shares of a stock like Apple or AMD or Microsoft. We're not all rich yet. And if you're thinking of trading these kind of stocks, these bigger name companies, then you might want to consider spreads. Now, spreads offer an almost unlimited number of ways to trade stocks. You can bet on a stock going up, you can bet on a stock going down, you can bet on a stock trading flat, or you can bet on a stock going in either direction. And while there's a lot of ways that you can trade spreads, the best way that I found has been by using credit spreads. So you're capitalizing on time eroding the value for your options. For example, I opened this 555, 560 call credit spread on Costco, assuming that it would be below my 555 strike price on my expiration date, which is this week on March 18th. And if I were to open this again, here's how it would play out. Costco fell by 1% on Friday, which isn't a ton, so we're going to extend the expiration date to April 8th. We're going to scroll up the option chain to find a call option that has a 20 delta. This 565 call has an 18.96, so that's close enough for us. We're going to sell this, and then we're going to buy one up from it for a total of $80 of credit in order to open this trade. But since the difference between our strike prices is $5, we're putting up $500 of collateral in order to open it. So we're getting $80 for a $500 investment. And if Costco is below our 565 strike price on our expiration date, we get to keep that full $80 of credit. But if Costco is above 570 or higher strike price on our expiration date, that's when we take our maximum loss, which is equal to the collateral, again, $500, minus our credit of $80 for a maximum loss of $420 if the stock is anywhere above 570 on our expiration date. Now, finally, if Costco is between our strike prices on our expiration date, that is when we can run into a lot of trouble. I've already covered this 100 times on the channel already. I even covered it in a short video they can check out. So let's move on to our next spread strategy. The next best spread strategy that I've been using has been on SPY. If we go to my history on this, I used a short iron condor starting on March 7th, and I got $150 of credit in order to open this. I closed this a few days later for a cost of $30, so I took $120 profit in 4 days. But this isn't the usual type of spread that I would consider. So let's go to SPY, and we'll go to their option chain, set our expiration date to 3 weeks out, since SPY only dropped 1.3% on Friday, which it wasn't a lot. April 8th expiration date, we're going to scroll up the option chain to find a call option that has a 20 delta. This 443 has a 19.23. The 442 has a 20.47. So we're going to sell the 442. We're going to buy a 447. So $5 difference between our strike price is $500 collateral. We're going to go to the put option chain, scroll down the option chain to find a negative 20 delta. So this 388 has 18.73. This 390 has a 20.03. So we're going to sell the 390 put, and then we're going to buy 5 strike prices below it, just like we did with the call, but above it. So we're going to get paid a total of $181 of credit in order to open this trade, which means that if SPY is between our 390 put strike price and our 442 call strike price, we get to keep this full $181 of credit. But if it's above 447 or below 385 on our expiration date, we'll take our maximum loss, which is going to be equal to the collateral of $500 minus the $181 of credit for a maximum loss of $319. And this strategy can be pretty lucrative because, SPY has been all over the place recently, but it's treated me somewhat well. If we go to the Iron Condor tab here, I made $399 using this strategy. And with credit spreads, I made $409. So in total, I've made around $800 by using these two spread strategies. But between the two of them, I'm a lot more successful using credit spreads than I am using iron condors, because I've taken 2 losses out of the 6 iron condors that I've opened, versus credit spreads, I've only taken 2 losses out of the 18 trades that I've used for credit spreads. Now, finally, the last strategy that I've got is for people who ended up buying stocks during the bull market and who have a super high cost basis for the shares. A way they can bring down your cost basis for owning 100 shares or more is by selling covered calls. And the way that the strategy works is you're going to start by selling a strike price above the current market value for the stock, agreeing to sell your 100 shares at your strike price. And the way that you choose your strike price, again, is going to be based on delta values. Now, with selling puts, we used a negative 20 delta value, but with a covered call, we're actually going to alternate our delta values depending on market conditions, because overall right now the markets are continuing to come down. So if the markets are performing pretty well over a period of like 2 to 3 days, this is unusual, and I like to set my delta value higher to capture a little bit more premium. So whenever the markets are performing pretty well for a few days, I like to set my delta value to 30, and I'm assuming that the markets are going to continue to come down. But whenever the markets are performing pretty poorly for 2 or 3 days, then I like to set my delta value lower to 20 to decrease the odds of the stock going up and me getting assigned to have to sell my 100 shares. Ultimately, I don't want to give up my 100 shares. I just want to collect the premiums. So a 20 delta value whenever the markets are performing poorly, and a 30 delta value whenever markets are performing pretty well for a few days. And again, with selling puts and credit spreads, we want it to have the same kind of expiration date. We're trying to capitalize on theta, but we don't want to set our expiration date too far out because of the high uncertainty. So instead of 30 to 45 days, we're using 2 to 3 weeks until our expiration date instead. So if I were to use a strategy right now, here's how I do it. With the cover call, you need to pick a stock that you own 100 shares of. And the only 2 stocks that I own 100 shares of on this portfolio is Himax and Maps, but neither of them are really worth selling calls right now. So if we go over to Fidelity, I own 100 shares worth of AMD. And I would take you through the process of selling call options on Fidelity, but the user interface is just so horrendous. So we're going to do this on Robinhood instead. Going to go to AMD, go to their option chain, and AMD fell 2.5% on Friday, which wasn't a ton. I've seen this stock drop by 6-8% in a day. So we're going to go with a longer expiration date, April 8th. Scroll up the option chain to find a 20 delta. This 120 call has a 20.69 delta, so we're going to sell this in order to open it, agreeing to sell our 100 shares of AMD at $120 if it's above that on our expiration date, which means technically we're selling the shares for a break even of $120 plus our $177 of credit for a break even of $121.77. And if AMD is below our 120 strike price on our expiration date, we get to keep our 100 shares that we own, and we get to keep the $177 of credit. And the strategy has treated me really well, making $1,150 over the past few months, but I am using more expensive stocks like AMD that cost me $10,000 to buy 100 shares of. Fulgent cost me like $7,000 to buy 100 shares of. Maps and Himax are definitely 2 cheaper ones, but going with these more established stocks has made me a lot more profit. I can sell these for $300, $400, whereas with Maps or even Himax, I'm only getting like $20 or $30. Anyway, these are all the strategies that I've got for you today. Thanks for making it all the way to the end, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.